Hello and welcome everyone to 15th episode of Talk with Daulat. I'm Rahul Verma, Content and Growth Lead here at Daulat. Today we have our founder and CEO Varun Puria with us to discuss on the topic active versus passive. Daulat is tech-enabled all-in-one platform that provides customer solution to Indians to invest better and reach their financial goals. Before Daulat, Varun worked in investment firms like Blackstone and Bloomberg and is also a NISM certified financial advisor. He also holds a degree in finance and information system from Hong Kong University of Science and Technology. Hello, Varun. Glad to have you here and hope you are doing well.
Thank you for having me on the show, Rahul.
Varun, there is a lot of buzz around active versus passive investing. Basically, what are they?
So definitely, I think this is a topic that has been bothering a lot of investors, specifically individual investors all across the country. So hopefully today through this episode, we'll be able to shine some light on the topics of active and passive style of investing. To put simply, active style of investing is a form of investment strategy where the investor or the fund manager aims to beat the underlying benchmark or the index. So let's say if you are investing in a large cap mutual fund, which a lot of the mutual fund investors are familiar with in the country today, the benchmark or the index specific to that category could be a Nifty 50 or a Nifty 100. The aim of the fund manager or the fund house over there is to try and generate returns over and above what the benchmark or the index can provide. That is simply what an active style of investing is, where the ultimate goal for the investor over there is to generate higher returns than what is provided by the benchmark. On the opposite side of things, passive style of investing is a style of investing where the goal ultimately is to just track and mimic the returns that is provided by the benchmark. Again, taking a similar example, if you're investing in the large cap space, which represents the top 100 companies in India, most probably the benchmark over there would be a Nifty 50 or a Nifty 100. And if you're investing passively, your only goal over there is to generate returns that is provided by any of those two benchmarks. That is what active style of investing and passive style of investing is. Both of those are individually styles of investing. And that is something that investors need to keep in mind before they construct their investment portfolio.
Thanks, Varun, for getting our basics clear. What are some benefits of this investment style?
So obviously, one of the biggest benefits of investing actively is the potential to generate higher returns. Here, the fund manager or the fund house, honestly, at the end of the day, goes to work so they are able to beat their underlying benchmark, and that is what the investors also compensate them for. So that is, I would say, I mean, at the end of the day, the only benefit of investing actively and probably the more important one. On the other hand, the benefit of investing passively is a bit different in the form of the lower cost that is passed on to the investor. Since there is no active role that is played by, let's say, the fund house in selection of securities that is selected by the fund manager or the research analyst, that automatically leads to a drastically lower cost in the form of a total expense ratio. As we have talked about in our earlier videos, total expense ratio is charged as a percentage of the overall AUM that a mutual fund company manages. And a large chunk of this TER is actually allocated towards the salaries and the compensation packages that is paid out to the fund managers and the research analysts. Now, since here we are effectively eliminating the job of a fund manager, that automatically reduces the total expense ratio, which is passed on in the form of a lower cost to the end investor. And number two, the second benefit of investing passively is since you are ultimately just trying to mimic the returns of what is provided by the benchmark or the index, there is obviously a lower monitoring that you need to do with respect to the portfolio. I think once you're satisfied with getting the returns that the benchmark or the index can provide, you pretty much no longer need to actively monitor your portfolio on a day to day or a week to week or a month on month basis. So that is the second benefit of investing passively.
How can one invest in passive based income, passive style of investing?
So let's say in all probability, if you had have invested in a mutual fund in the last, let's say 1 year, 3 year, 5 year, whatever time horizon is, or whenever you had started investing in mutual funds, right? If you have invested, there is a very high likelihood that you have invested in an actively managed fund, where at the end of the day, the goal of the fund manager is to beat the benchmark that is specific to the strategy of that fund house. On the other hand, investing passively, either you could invest through an index fund or something called as an ETF or an exchange traded fund, which is similar to an index fund. But the difference here is that these ETFs are actually traded on the stock exchange, similar to a single stock. So let's say, for example, if you want to invest in Nifty 50, which represents India's top 50 companies, right? Either you could buy an index fund which tracks this index. So in that case, basically the fund house replicates the holdings that is held by the benchmark over there. So in the exact same proportion of the benchmark and the index. Or you could simply also buy an index fund ETF, which is traded on the stock exchange, and you can buy and sell just like how you would buy and sell a stock. So that is how you can invest passively through an index fund or an ETF. Or on the other hand, if you want to basically invest actively, I would say India still as a country has a majority of actively managed funds where the goal of the fund manager is to beat the benchmark. So let's say if you're investing in the large cap space, mid cap space, multi cap space, small cap space, all of these strategies have a lot of actively managed funds. So if you go and pick up any of the fund, there is a very high likelihood that you have selected an actively managed equity fund.
Great. So my next question would be, what are some characteristics one individual should consider before deciding his style of investing?
So it is really important to firstly understand your own risk tolerance and your time horizon for investing. And the reason for that is, let's say if you are investing in an actively managed fund, there is again a very high probability that there would be periods of underperformance where the fund manager is not able to beat the benchmark, at least in the shorter term. That is something that we have seen as a trend over the past few years. And that is a trend that will probably continue in the future going forward. I think it has become really difficult today for fund managers, obviously, to extract alpha. That is not to say that there are no alpha generation opportunities available today in the market. So I think it is for you as an investor to decide what form of and what style of investing you as an individual investor familiar with. If you are, let's say, comfortable with those drawdowns and volatility and the kind of ups and downs that you typically see in an actively managed fund, where there could be periods where it underperforms the benchmark or the index, but there can also be extended periods of time where it significantly outperforms. So you need to have that, I would say, behavioral comfort to be able to withstand the volatility. On the other hand, if you are more on the passive style of investing where you're just happy with getting the returns what the broader market can provide, and you do not really want to actively monitor your portfolio frequently, then the passive style of investing is more suitable for you. Our suggestion, our recommendation is, it is not a case or a debate between active or passive. We feel there is an opportunity for both active and passive strategies to exist in the market. It is ultimately for you as an investor to decide which pockets of your portfolio is allocated towards lower cost passive funds and which pockets of your portfolio is allocated towards actively managed funds.
What is the CGR of active fund when compared to a passive fund?
Again, so it is really difficult, Rahul, to put a number to this because, again, it depends on the specific fund manager and the fund house and the specific scheme. Since, as we talked about, passive is not a single specific scheme, it is a style of investing. So, let's say over the past 5 years, Nifty on an average has delivered anywhere between 12 to 13%. I think that is broadly what the expectation is of investors today investing in the equity markets who invest passively. They try to sort of assume a return of 12 to 13%. But on the other hand, if you look at the performance of actively managed funds, there is a huge spectrum. At one end, you will definitely find significant laggards who have not been able to, I would say, even generate 8 to 10% of returns. But on the other end of the spectrum, you will also find schemes who have been significantly outperforming the benchmark on the index on a consistent basis, generating returns as high as 17, 18% over the last 4 to 5 years. So again, it is a huge gamut and a spectrum of return dispersion across actively managed funds. So that is where I would say the role of a wealth manager, that is where the role of a research comes into the picture, where you need to actively see which sort of a fund is performing well and not just look at from a return point of view. Understand the strategy, understand the market in which the returns have been delivered, and then compare that to the performance of a passively managed fund in the same period.
Thank you, Varun. Hopefully, we would be discussing how to choose active funds in the future, how to decide
Thank you
which
so much.
active fund to choose.
Thank you so much, Rahul, for having me on the show. I hope through this episode we were able to shine light on the importance of active and passive style of investing, and more importantly, what role each of those investment strategies play into your overall financial portfolio.
Thank you, Varun, for your time.
Thank you.